Hello everyone, and thank you for tuning into today's video. I'm Gayatri from Index One, and I'm joined by Chris McAfee and Craig Camille from BX. Welcome to Portfolio Strategies Outlook, which is a quarterly content series designed to keep you informed on market trends and evolving investment strategies. Be sure to subscribe to our email notifications so you don't miss the next video. In this session, we'll recap recent market developments, analyze strategies that have been performing well and those that haven't, and explore emerging investment approaches. We'll also highlight new strategies set to be calculated by Index One, where we're committed to supporting money managers by calculating innovative index strategies and providing timely insights into market trends and dynamics. With that, Craig, over to you.
Thanks, G. So what we normally do on this call is just frame up the state of the markets and look at how the benchmarks are performing, and then we go into some specific strategies. And we normally pull up the chart of the S&P 500, and we've done that here, but rather than looking at it like how is it doing today or in the short term, we wanted to take a look at the 5-year chart. So if it went back further, you would see that the S&P 500 was going down all of 2022 to the tune of being down about 25% for the year. It bottomed out late in the year. And what's really interesting about that is if you look at the bottom there of September, October of 2022, we've been on an amazing bull market with the S&P 500 going up about 150% since. Obviously, we've had a couple of pullbacks along the way, but if you just took 2 points and we're in the S&P 500, you have done very well. Let's just take a look for a second at some of these pullbacks. So in late 2023, we had a pullback of about 10 to 15%. In early 2025, we had the tariff pullback. So the world economies were very uncertain in terms of what was going to happen to the tariffs. President Trump then put a pause on the tariffs, and we went right back up to where we were. And then earlier this year, we had the beginning of the war with Iran in the Middle East, and that created a lot of uncertainty around oil and the markets. But once that pause again, if you will, was agreed to, then the markets took off again. So this is just really interesting because it sets the stage for a couple of things that we're going to be talking about, which is the need for risk management and the need to be invested for growth at certain times. And G, why don't we go to the next page? These are some of the benchmarks, and most of these are ETFs. But if we look at the left-hand box, these are the year-to-date returns as of Thursday. So we can see that the top of this list is the Russell 2500, the iShares small cap, the MSCI X, the US, the Standard & Poor's mid cap ETF. So the top performers year to date have been the small, the mid, and the international categories. And we've seen this before. The underperformers at the bottom, excluding the aggregate or the bond market, are the dividend growers and the value stocks. If we go to the box on the right, we take a perspective of looking at 2022, 2023, and 2024. And we see that the growth ETF has been a very solid performer in 2024. But what's interesting to note here is if you look at the growth ETF in 2024, up 35, in 2022, it was down about 30%. And if you go down a category to mid-cap ETF in 2024, it was up 14%, but in 2022, it was down 13%. And if we go down to the ProShares Dividend Aristocrats, it was up 6 and down 6 in those same years. And so we wanted to highlight that because, obviously these are very good performance numbers, but if we go all the way back to 2022, we can see that the drawdowns in most cases were as bad as some of the good years were in making money. And we think that's really important to keep in mind as we come off of a 4-year, very, very strong performing market to say, what is that potential max drawdown that could be lurking out there if we have another pullback like we did in 2022. So if we can go to the next page, What we're going to do is just get into some observations that we notice. And we wanted to pause here for a minute and talk about active. So by definition, the passive indexes are going to match up with their benchmarks, or they might in fact just be a benchmark. So what BX does is we search the world for very active managers that might have concentrated positions, specialized in certain things. In a typical year, we'll meet and interview 200 or more money managers, and they collectively have like 1,000 investment strategies. We then whittle that down to the very best strategies, and then the very best managers based on the due diligence criteria that we run them through. Their research, their length of track record, their ability to outperform the markets, our belief in them that they can outperform the benchmark over a market cycle. And if a lot of these things go well, we'll add them to our platform and simultaneously the Index One platform. But what we're going to pivot now to is, can you see consistent outperformance with active strategies? And so Chris is going to walk you through the categories of performance and the average outperformance. And these numbers are through the first quarter.
Yeah, so through the first quarter of 2026, we can see that virtually every category of strategy that is showcased by BX is outperforming its benchmark year to date. You can see outperformance rates in the 70s and 80s throughout all the categories. Interestingly, large cap value is showing the biggest margin of year-to-date outperformance, and then U.S. large cap core, international SMID. So I think what this is telling us is the selection process and deselection process really, works when it's applied consistently. And you can find alpha in any kind of strategy as long as you find the right managers behind those strategies and the right systems behind those strategies. And I think that's what this is telling you, because there's no obvious jump off the page answer to, what's working or what BX type managers are doing the best. We can find outperformance across the spectrum. We just have to look for different types of techniques in different categories.
So what we wanted to note here was that there's a couple of key trends that we're seeing. The first is active management, that based on the perch that BX and Index One sit on, if you find good active managers, you can consistently see alpha, and we've seen that, as Chris was just referencing. The second point is not beware, but be aware of 2022. Just because we had such strong performance and very mild recoveries, that we always want to be prepared for the down 25% maximum drawdown in the markets. The other thing is we've consistently seen over the last 3 or 4 years these 4 to 6 month runs. So as we were both just alluding to, we might see like international and small and mid cap do well in the first half of the year, and then we'll see large cap and growth do better in the second half of the year, or vice versa. We've not seen a year where a category is sort of leads the year from start to finish. And every year for the last 4 or 5 years, we've seen rotation. So we think that's really important to be aware of. And it's a good time to think about rebalancing or readjusting a portfolio after we've had one of these 4 to 6 month runs. Fixed income, we think, is another major theme. We had a 30-year bull market in fixed income. Starting with COVID, in the tail end of COVID, we've been in a bear market for fixed income for about the last 5 years. If you really look at what your return is on the ag for the last 4 or 5 years, you average about 1%. And, by all accounts, it's going to be a hawkish Fed, and the likelihood of and interest rates going up is real. So we think that if you're going to be in fixed income, you want to have risk management in place, and you want to have active management in place. The fifth point, diversification. Even though growth has been the strong winner over the last 4 years, other categories have had their moments, and it's really paid investors to diversify. because it lowers your overall risk and builds out a much better portfolio. And then we always like to talk about growth and value. Year to date, VTV is outperforming growth 13% to 7% relative to an S&P SPY plus 9%. But over the last 5 years, growth is up 88 and value is up 60. So we definitely view the world in this: should I be in growth or should I be more defensive? At the moment, all three of these ETFs have had a very good beginning to this year. So I'll throw it back over to Chris, and he can talk about some of the top performers year to date.
So once again, you can see kind of the same pattern emerging in this data as we saw in the last set of data that we were looking at performance-wise, which is there's really no, this is relative performance versus benchmarks. And by the way, this should be eye-popping to see all these double digits outperforming against their benchmarks. That's kind of hard to come across. And I think it speaks to the, once again, to the selection process. But you can see that it's just a huge spread of different managers and different types of strategies delivering these margins of outperformance. You can see a thematic, you can see two Bitcoin strategies. Now, granted, they're both down, but Bitcoin itself is down tremendously. We're going to talk a little bit about that in a minute when we get to the next one. Then we've got another thematic, a macro factor rotation, a large cap growth, real assets, and international. So really, really generating alpha from all sorts of different sources. And that's kind of what we like to be able to do, so that when you cobble together a portfolio that's blended, you're going to be in a position where you have the potential to have a very, very solid result. And then you can see the same sorts of themes emerging in the 3 and 5 year numbers. Those. So you can see momentum, you can see tech, you can see value, you can see sector rotation, and this is 1,000 basis points of outperformance over 3 and 5 year periods. It's just we're very proud that we were able to put this kind of collection together. Where you see this global, moderate, aggressive, those are ETF-based models where BX has close relationships with some ETF issuers that also issue index strategies, and we leverage their intellectual property and their ETFs to create these blended portfolios that have delivered just really, really solid performance. So I had mentioned Bitcoin, and it's funny because nobody's talking about Bitcoin right now because it's not doing very well, and frankly, contrarian in us says, well, maybe that's time to take a look rather than when everybody's on the bandwagon. So at BX, we love diversification benefits, but we hate drawdowns, right? So we didn't really know how to best approach the crypto space. So we spent a lot of time working with our partners, and we had 2 different partners that we worked with that have 2 very different systems for managing risk in the markets. And we wanted to see if those systems could be applied to Bitcoin in a way to create a Bitcoin trading strategy that was in fact risk aware, risk managed, risk controlled. So these strategies are still going to be very volatile. It's just that they're very much less volatile than the coin itself or the Bitcoin ETF, which is what the underlying vehicle for trading these strategies is. So you've got the BX risk managed Bitcoin strategy, which employs the phase detection technology that you see in so many of our strategies, and the Dynalogic tactical strategy, which is, so they both can either be basically just in Bitcoin or cash and in various percentages. And the whole idea is to create a Bitcoin-like return over time with much less volatility and much smaller drawdowns. And in fact, that's what this combination does, because not only do both of these strategies protect against some of the risk that's inherent in Bitcoin, right? But they don't correlate perfectly with each other either, so that you've got a diversification benefit there as well. So really interesting. So you can see on the next slide, So we don't necessarily recommend giant heaps of Bitcoin exposure because that's going to be too much risk for most clients. But by taking 10% of that combination that I just showed you and plugging it in with one of our more traditional models that we call the Alpha Seeker, we created something that not only delivers much better performance than Bitcoin and much better performance than the S&P 500, but with a much smaller maximum drawdown. And that's really the kind of outcome that we're looking to deliver at BX. Because what happened is, since the traditional, the Alpha Seeker strategy is built with very diversified components, and then Bitcoin is another level of diversification, even though the Bitcoin is volatile, because it doesn't correlate perfectly with the other sleeves, you wind up with an actual lower overall risk, even though you've included Bitcoin and improved the potential for total return. So we can work with you to create the right kind of strategy that works for your book and your clients. But we wanted to show this because it's kind of what BX is all about.
So this is the public website, index1.io. This is where BX and Index One collaborate to do due diligence, backtest, keep track of strategies in the form of an index. And what we've done is just clicked on the BX indexes underneath issuers. And the reason we really wanted to bring this up was we positioned it to show performance year to date from top to bottom. And you can see that in this example, the top performing index year to date is the Syntax Cloud Computing, followed by Ascent, followed by Trend Capture, and so on. But what's interesting is to keep in mind the S&P is up about 9% for the year. Clearly, many of these strategies are up much more than the S&P 500. But what's interesting is that the two things stand out to us. One is that there's on this page alone about 10 different money managers or strategists that are all generating tremendous alpha. The second thing is categorically, they're in many different places, from technology to growth to value to international, small and mid cap, as well as tactical. So it's not like this is not a year where all the growth strategies are going up and all of the some other category are going down. We're seeing really good money managers deliver really good performance regardless of what their style or benchmark is. If you'd like to get a complete list of all of the BX and or Index One indexes, just send one of the three of us a note and we can get you over a full performance report. And this is the BX team. We wanted to put this up here. We work very closely with the Index One team, but we had previously mentioned we do a lot of due diligence and trying to surface strategists around the world that go through very rigorous due diligence before they come onto our combined platform. And these are some of the folks that do that work, so that when we do say, hey, let's bring this strategy onto our platform, we have a lot of confidence that it will be able to do the things that we spent our last half hour talking to you about. So, G, thank you so much for organizing this, and I'll turn it back over to you.
Thanks, Craig, and thank you both for your insights. And as Craig's mentioned, at Index One, we offer a holistic index calculation platform that delivers fast, flexible, and scalable indexing solutions. So we help build indices based on fully custom strategies with tools for backtesting, index calculation, rebalancing, corporate action processing, and distribution. And we calculate over 80 indices for BX at the minute and continue to collaborate with them on bringing these innovative and robust investment strategies to life. So to our viewers, you can explore all the BX models mentioned in today's session on both BX's and Index One's websites. And in the meantime, be sure to subscribe to Index One's and BX's email newsletters to stay updated on our next Portfolio Strategies Outlook video. Thank you for tuning in, and we look forward to seeing you next time.
Thanks
both.
Thanks, Steve.